investing $100,000 with an average market return of 7% annually, you'd have about $386,968 in 20 years. But if you outperform by just 3% and achieve a 10% return, you'd end up with $672,750, nearly double. How? Understand market fundamentals and use stock screeners to automate investment choices, saving time and boosting strategy. You need to understand market fundamentals, analyze stocks properly, and stay ahead of trends. Utilize stock screeners to automate the process of identifying potential investments, because they can filter thousands of stocks based on criteria you set, like growth rates, dividend yields, or P/E ratios, allowing you to quickly find stocks that match your strategy without spending hours on research. You can even automate these screeners to send alerts or updates, so you stay informed without lifting a finger. No big money? No problem. How to outsmart the S&P 500 without risking it all? You might feel that trying to outsmart the S&P 500 requires a large amount of money or taking on significant risk, which feels too dangerous for your current financial situation. This fear of losing money can keep you from investing altogether or lead you to stick with the safer, low-return options that don't help you reach your long-term goals. Outsmarting the S&P 500 doesn't mean taking on reckless risks or needing a large capital. It's about making smart, calculated decisions that align with your financial situation and risk tolerance. Even small strategic improvements in your investment approach can yield significant gains over time. By understanding that you can start with whatever amount you have and make informed choices, you can grow your wealth steadily without taking on unnecessary risk, giving you greater financial confidence and security. Let's start with the wrong ways to break ahead of the S&P 500. Believe it or not, many investors are trapped in these pitfalls, thinking they're on the right track when they're actually sabotaging their own success. One of the biggest mistakes many investors make is chasing hot stocks. We've all seen it happen. There's a buzz in the air. Everyone's talking about a new trendy stock that seems like a surefire win. It could be a meme stock that's gone viral on social media, like GameStop or AMC, or a company that's made headlines with a big announcement like Tesla after unveiling a new innovation. The temptation is strong, and it feels like everyone around you is jumping on the bandwagon. So you rush to buy, thinking you're about to make a quick profit. But here's the reality. By the time you hear about it, the stock has often already peaked. You're buying at a price that's been inflated by all the excitement and hype. When the frenzy dies down, and it almost always does, you're left holding a stock that's rapidly losing value. It's like arriving at a party just as everyone else is leaving. You think you're in on a great secret, but in truth, you're too late to the game. The pros who got in early have already cashed out with their profits, while you're stuck with an overpriced stock that's plummeting. Consider the example of GameStop in early 2021. The stock skyrocketed from around $20 to nearly $500 within weeks due to a viral social media campaign. Many retail investors, hearing the hype, jumped in at the height of the frenzy, believing they were going to ride the wave to wealth.